In today's video, we're going to cover off on some of the key topics that are affecting Aussie expats at the moment. Unfortunately, they're not going to be where to get your latest supply of Tim Tams. We're going to run through something even more exciting, and that's the financial issues that expats are facing today. Some of the topics we're going to discuss include superannuation, what to do with that as a Aussie expat. The next one's going to be what to do with your money, where do you accumulate those funds. The third issue is going to be, could you be at a financial disadvantage by being an Aussie expat? And lastly, we'll cover off the HECS and HELP repayment facilities that are going to be coming out of the ATO over the next 12 months. So let's start off with superannuation. Unless you became an Aussie expat straight out of school or university, more often than not, you would have worked for a period of time in Australia and accumulated some sort of form of superannuation. The good thing about being in Australia is you're bombarded by advertisements telling you to take your super seriously, and you can't help but not take notice of it at certain times. Unfortunately, as soon as you get on that plane and flying off to distant shores, the noise of the super advertisements disappear into a very quiet whisper, and usually that just becomes a yearly statement that gets sent out by the respective super funds. More often than not, when people sign up as a client of ours, one of the first tasks we actually go through is to consolidate super. A majority of people do have a number of super accounts, and it's very easy to lose track of these. So the first port of call is always to consolidate your super. When your super is consolidated, it's a lot easier to manage and a lot easier to take care of. The next step we go through is to actually look at the insurance inside of your super. Most super that people have attached what's called group cover. Group cover is generic cover that applies from someone the age of 20 through to 60. It's not specific to your circumstances or your residency status. Quite often this group cover is ineligible for Australian expats, yet you may have actually been paying for this cover for the last period of time that you've been away, 2, 5, even 10 years at times. So the first thing you need to do with group cover is to determine your eligibility as an expat. Then you need to determine whether it's in your financial best interest to contribute to your super whilst you're an expat. One thing we'd like to squash is the expat urban myth that you cannot contribute to super whilst you're a non-resident. Superannuation is actually agnostic when it comes to your residency status. You get the same perks and bells and whistles as a resident as you do as a non-resident. So it's not actually illegal to contribute to your super, but you need to work out what's in your best interest whether you do that or not. A lot of the time we meet people who dismiss their super, describing the balance as small or inconsequential. However, we often find that by the time we look at these things, they're actually not that small. The example I use is if you're walking on the street and you saw $20, $30, even $50,000 on the street, would you pick it up? I dare say you would. And the same can be said with super. Now, you may be 30 years of age and you can't get access to your super for another 35 to 40 years. However, it's the small changes done early that give us the biggest difference down the track. So do take a super seriously early because the benefits can be massive. When you're reviewing your super, always make sure look at your investment selections. There'd be nothing worse than taking your super seriously in 10 years' time to find out that you've actually been in the conservative option and your portfolio growth has been hamstrung by your lack of attention. The next topic we'll go into always generates a lot of discussion, and we'll actually go into this in further weeks, but I just want to cover off on the topic of where do you accumulate assets. The general rule of thumb we say to clients is you want to accumulate assets in the country and the currency that you intend to return to or retire to. The reason being is, as an Australian expat, your biggest financial risk is actually currency risk. Now, the big investment banks with their millions of dollars and their big computers, they have no hope of determining what the foreign exchange rate is going to be in the medium and long term. So what hope do you have? The best way to do this is to move your funds to the currency or country that you intend to return or retire to in stages. By doing it either monthly, quarterly, annually, what you're doing is taking advantage of a process called dollar cost averaging. Now, sometimes you may get the best exchange rate and sometimes you may not. But by the time you've actually returned to the country you intend to return to, you've actually got quite a good average exchange rate, as opposed to drawing a line in the sand and just picking numbers out of the dark. Sometimes you'll get very good and sometimes you'll get a very bad exchange rate, and that's down to luck. Increase your odds of getting a better exchange rate by increasing the frequency of movements. Often when I mention that Aussie expats could be at a financial disadvantage compared to their Australian colleagues, I get met with blank stares. And the reason I say this is because every week, every month, every year, your Australian colleagues have 9.25% of their set income being contributed to their super every year. Now, unless you're either matching this or increasing this, then 9 times out of 10, your Australian colleagues are actually financially better off than you are. Now, you may be on a fantastic package overseas, or you may be on a similar package overseas than what you would be in Australia. But unless you have some sort of savings plan set up and some sort of money put aside, then more often than not, you return to Australia with lots of great memories and stories, but not a lot of financial assets to show for it. Now, this next topic of conversation has generated a lot of debate, and that's the Australian Tax Office enforcing Australian expats to repay their HECS and their help debt. Essentially, the way the rules work now is anyone going overseas after the 1st of January 2016, you have 7 days from the date of departure to notify the Australian Tax Office of your new details via their online services. For those expats who are already overseas, you have until the 1st of July 2017 to do the same. What this requires is you need to now disclose your overseas assessable income. If that income is greater than $54,126, then you will then be required to start repaying back your Australian HECS and help debt. Regarding the ins and outs of this, don't worry too much about it. We're actually going to start covering off in more detail in the coming weeks how this is going to work and the best process to take from here. That's it for this week's edition. So don't forget, if you have any questions, tweet us at #AskAtlasWealth or leave your comments in the box below and we're sure to get back to you. Have a great day.